Today, we're going to be talking about what's happening in the real estate market in Surrey, British Columbia, and the whole entire Fraser Valley. So let's get right into it.
Banks, the CRA, and the government are now aligned in tackling mortgage fraud, risky lending, and real estate market instability by sharing data, enforcing stricter regulations, and coordinating their efforts. Well, in the past, these institutions operated more independently, leading to gaps in oversight. Now, let's break it down a little bit. Banks focused on approving mortgages, but had limited access to tax records to verify incomes. The CRA mainly enforced tax compliance, but did not actively monitor mortgage fraud in real time. The government introduced policies, but without full coordination with lenders and tax authorities. Enforcement was weaker. Now they're working together more closely by sharing data and enforcing rules in a unified way. They're going to be applying stricter lending rules, conduct enhanced income verification, and report suspicious activities. Now, what's the bottom line? Before, banks, the CRA, and the government operated in silos, which allowed for fraud and risky lending to go unnoticed and undetected. Now they're actively working together, aiming to create a fairer, more stable, and more transparent housing market that protects both the buyer and the economy in itself.
So do you feel that the Canadian government is actively trying to lower home prices? Or is the focus more on stabilizing the real estate market?
Well, Rick, yes, the Canadian government is actively trying to bring home prices down, but in a controlled decline rather than a crash. Now, why? Prices have outpaced incomes, making home ownership unattainable for many, especially first-time home buyers. Housing costs are a major political issue right now, and the government needs to act to maintain voter support. Policy like foreign buyer bans and anti-flipping tax aim to limit investor activity and make homes more accessible to the end user. The Bank of Canada rate hikes have made mortgage costlier, forcing sellers to lower prices while also tracking and tackling inflation. Faster approvals, tax breaks for builders, and rental incentives aim to increase supply, easing price pressure. The government wants prices to drop gradually, making homes more affordable without destabilizing the economy or hurting existing homeowners.
So Jeff, RBC is predicting that the Bank of Canada will lower interest rates to 2% by July 2025 this year. What do you think about that?
RBC's forecast suggests that the Bank of Canada is planning to cut interest rates aggressively to help the economy, eventually bringing the interest rates down to 2% by mid-2025. This means that RBC believes that the Bank of Canada is seeing signs of an economic slowdown, like higher unemployment and weak growth, and wants to make borrowing more cheaper to boost spending and investment. Now, if this happens, it could make mortgages and loans more affordable, but it also depends on how inflation and other economic factors play out in the coming months. Now, of course, this is just a forecast. Things could change based on new economical data and unexpected global events. The Bank of Canada will also adjust for plans as needed.
Okay, now let's quickly go back to what happened in the real estate market last year in 2024. There was a ton of homes for sale last year in 2024. 2024 had the highest number of new listings in the past 10 years. Over 35,000 homes hit the market. That's 9% higher than the average we've seen in the last decade.
That's right, Ricky. However, sales didn't keep up. Only 14,570 homes sold last year, which is the lowest we've seen in a decade. And when you break it down, most of those sales were concentrated in Surrey, which accounted for over half of all the transactions. Langley, Abbotsford followed, but even their numbers weren't that impressive. It seems like buyers just weren't jumping in even when, well, they had all that inventory.
So it seems a big part of that is hesitation. Hesitation had to do with affordability. Even though the Bank of Canada cut interest rates midway through the year, it didn't really solve any core issues. It made borrowing slightly cheaper, but it wasn't enough to make homes affordable for most people. And with the cost of living being so high, it definitely didn't seem to help either.
And that's reflected in the prices. The composite benchmark price for homes in the Fraser Valley ended the year at $965,000. Now that's down 2% from 2023 and 4% from the peak in March 2024. Now, on paper, that sounds like progress. Prices are dipping, but in reality, it's not a big enough drop to make much of a difference. Think about it. Even with a small price drop, you're still looking at close to $1 million for an average home. So for many buyers, that's really just not realistic, especially with wages not keeping up with other costs of living on the rise. Kind of like what you said.
Yes, it seemed the overall market felt a bit sluggish. By December 2024, the market was technically balanced with a sales to active listings ratio of 16%. That's within the 12 to 20% range. We considered it balanced, but activity levels were low. Buyers weren't buying and sellers weren't selling as quickly as they dropped.
Oh, Ricky, that's a great point, but I do want to correct one point here. We actually had a balanced market almost all throughout to the end of the year. Although, as we just said, we had a balanced market from that time, we kind of continued it the whole way through. But it is a great point. Homes were sitting on the market a little bit too long. In December, townhomes averaged 36 days before selling. Condos were at 38 days, and single-family homes didn't really budge at 43 days. Those numbers are all higher than what we'd all typically seen, especially for regions like the Fraser Valley, where things used to move much, much faster.
So it seems 2024 was a year of contrasts. On one hand, we had record high listings, which should have been a good thing for buyers. And on the other hand, we had record low sales, which tells us the market's biggest challenge, which was affordability, is far from being solved. And if any of you are planning on making the move to the Surrey, BC area or anywhere in the Fraser Valley or Metro Vancouver area, don't forget to give us a call. The number will be in the description below. We absolutely love getting reach outs from every single one of you. So please make sure to call, text, or email us if you're planning on making the move out here or around the area. You can also schedule a call or meeting using the link in the description of this video, and you can get yourself the new JC Homes or Ricky J the Realtor thermal travel flask mug or a free t-shirt or one of our new really cool desktop phone holders, which everyone's been loving. All you have to do is drop a comment saying I have subscribed in the comments section of any one of our videos after subscribing to our channel, and I will send you out one of these items for absolutely free. And now back into the video, Jeff. With Justin Trudeau resigning, many Canadians are questioning what this means for the country. At the same time, current President Donald Trump has stated he wants to take over Canada and has introduced tariffs on Canadian goods. How big of an impact could this really have?
Well, that's a great question. Well, Trudeau's resignation creates some political uncertainty, but when it comes to real estate in BC, the bigger trend we're seeing is a shift where supply has picked up and demand has slowed. There's a few reasons for this. Now, more homeowners are putting their property on the market either because they're looking to downsize, relocate, or cash out, while prices are still relatively strong. Many potential buyers are kind of still waiting on the sidelines, either because they feel prices could come down further or they're being more cautious with their financial decisions. New rules such as short-term rental restrictions and foreign buyer bans have reduced speculative demand and increased available inventory. With ongoing decisions about tariffs, trade policies, and shifts in government leadership, some buyers and investors are hesitant to make big financial commitments as of right now. Now, as of Trump's tariffs. If the cost of materials like lumber and steel increase, developers might slow down new constructions rather than pass those costs on to the buyer in a cooling market. This could eventually balance out supply and demand, but for what we're seeing in the market right now, buyers have more options and sellers need to be more competitive.
Well, Jeff, with all these changes and Trudeau resigning, Trump's tariffs and shifts in the market, what could this mean for real estate prices here in BC?
Well, Ricky, right now, we're already seeing supply pick up and demand slow down. And with these changes could reinforce that trend. There's more listings on the market. Homeowners who are holding off may decide to sell now, increasing supply, while there are other more homes available. Prices tend to soften. With uncertainty in leadership and trade, many potential buyers might wait and see how things unfold before making a move. Less demand can put downward pressure on prices. Now, if tariffs raise construction costs, developers might delay new projects. In the short term, this could reduce future supply, but it likely won't offset the cooling demand. Both domestic and international investors may be more cautious in uncertain political and economical climates, further dampening the demand. Overall, we could see prices stabilize or even decline slightly as the market adjusts. But as always, BC real estate is influenced by many factors, and long-term trends will depend on how everything plays out in the coming months.
Jeff, with everything happening, Trudeau's resignation, Trump's tariffs, and market shifts, the Canadian dollar would also drop even more, most likely, right?
Well, it's very possible. Political uncertainty, trade tensions, and economical shifts can put pressure on the Canadian dollar. If investors lose confidence or if trades with the US become more expensive due to the tariff, we could see the dollar weaken further. A weaker dollar could have mixed effects on the real estate industry. If the dollar drops, BC real estate could become more attractive to foreign buyers who see it as a discount. This could help stabilize demand in certain segments. Now, on the other hand, if the cost of goods, services, and borrowing increase due to the weaker currency, local buyers might become more hesitant, which could slow demand further. Many building materials are imported, and if the dollar falls, the cost of those materials go up. This could make new construction more expensive, leading some developers to slow down on their projects. So while a weaker Canadian dollar could attract foreign investments, it could also contribute to higher cost and more cautious local buyers, adding to the overall trend of slowing down the market.
Well, we've already seen many developers kind of bail out on projects recently within the last 3-4 months, you could say.
Oh yeah, there's so many.
So that would be in general, fewer new builds might happen as well, right? In general.
That's correct. If lumber and steel and other building materials become more expensive, it cuts into the developer's profit margins. Some might delay or cancel their projects until the cost stabilizes. Many new developers rely on pre-sales to secure financing. And if buyers are hesitant due to economical uncertainty, developers might struggle to hit their targets, causing projects to be postponed, which we've actually already seen. Banks and lenders tend to be more cautious during uncertain times, making it harder for developers to get the funding they need to start large-scale projects. Fewer new builds would reduce future housing supply, but since demand is already slowed, it may not lead to a price spike right away. Instead, we could see a period where the market stabilizes before developers feel confident enough to wrap up construction again.
Okay, so can you explain the current capital gains tax policies affecting British Columbia real estate in 2025, including any recent changes or deferrals?
In 2025, there have been significant developments in capital gains tax policies impacting the real estate sector in British Columbia. The federal government have proposed increasing capital gains inclusion rates from 50% to around 65-66% for businesses and individuals with gains above $250,000. Additionally, British Columbia introduced a new home flipping tax initiative effective January 1st, 2025. This tax is designed to discourage short-term property holding profits. It imposes a 20% tax on the net taxable income from properties sold within 365 days of the acquisition. The tax rate decreases proportionally for properties held between 1 and 2 years and does not apply to properties held for more than 2 years. Certain exemptions exist, such as for primary residence and specific life circumstances. Now, it's important to stay informed about these policies as they can significantly impact real estate investment strategies in the province.
But doesn't the home flipping tax gradually go down if you hold onto the property longer? Like after the first year, the rate starts to decrease until it's zero at the 2-year mark, right?
Well, Rick, yeah, you're absolutely correct. Home flipping tax in BC is structured to gradually decrease over time for properties sold between 1 and 2 years of ownership. If you sell within the first year, the 20% tax applies to the net taxable income from the sale. After the first year, the tax rate begins to decline, reducing incrementally till it reaches 0% after 2 years of ownership. What this means is that the longer you hold on to the property, the less tax you owe until the tax no longer applies at the 2-year mark. The intent behind this is to discourage quick flips for profits while still allowing for flexibility for those who may need to sell for legitimate reasons.
So not good for investors, right? And if you're a non-resident, it's only getting tougher. The withholding tax on selling Canadian property has gone from 25% to 35%. That's a pretty big jump.
It's huge. As of 2025, the withholding tax for non-residents selling Canadian real estate has increased from 25% to 35%. This applies to the gross selling price of the property, not just the capital gains. The government is trying to ensure non-residents pay their fair share on taxes on real estate transactions, especially as properties property's value continue to rise. When a non-resident sells a Canadian property, the buyer is required to withhold 35% of the sale price and remit it to the Canadian Revenue Agency, CRA, unless the seller applies for clearance certificate. The seller gets some of it back, but yes, they need to file a Canadian tax return to report the actual capital gain. If the withheld amount exceeds their tax liability, they can request a refund from CRA. This change makes it more costly and complicated for foreign investors to sell property in Canada, reinforcing the government's focus on keeping housing more accessible for their residents.
And for all this happening while the CRA is implementing these rules, even though Parliament got interrupted, they're not waiting for full legislative approval. They're pushing it through based on earlier motions. It's kind of wild, like they're not leaving any loopholes open, or at least it seems like it. Now, what do you think this means for people trying to sell real estate, especially those whose capital gains are above $250,000?
Well, it's clear. CRA isn't waiting for the usual legislative process. They're enforcing these tax changes as if they're already in effect. Some of them are, some of them aren't, and more changes are coming. That's a major implication for people selling real estate, especially those with capital gains exceeding $250,000. The capital gain inclusion rate has increased from 50% to 66.67% on the portion of gains above $250,000, meaning sellers will owe more tax on large property sales. The CRA is closing loopholes and increasing enforcement, meaning sellers need to ensure that their paperwork is solid and, well, they're prepared for additional tax for review. With these aggressive implementations, sellers have limited options to minimize tax liability. The principal resident exemption is still in place, but for those investment properties or secondary homes, there's less room to maneuver. Sellers may need to have a clear plan for their sales, possibly structuring deals or spreading gains where possible to avoid exceeding the $250,000 threshold in a single year. Anyone selling real estate with large capital gains needs to be proactive, get tax advice, and plan their sales strategy to avoid unnecessary tax burden.
This is definitely going to change how people approach real estate investing. All I know is you'd better have a good accountant this year. I've said it before many times, and if you're one of those people out there, I might have someone for you. Give me a call.
We may have 3 people.
yeah, at least 3 people.
We have 3 people to call.
So, Jeff, will mortgage rates drop even more significantly? They're tied more to long-term bond yields, so homeowners might not feel much relief.
Well, mortgage rates, especially fixed rates, are closely linked to the long-term bond yields. When bond yields decrease, fixed mortgage rates often follow suit. Though not always immediately, recently the Bank of Canada reduced its policy rate by, 0.25, bringing it to around, 3%. This move has led to a decline in bond yields, which could result in lower fixed mortgage rates. However, lenders may feel more cautious in passing on these reductions to consumers due to the economic uncertainties. Therefore, while there may be some relief for homeowners, it may not be substantial or immediate. It's essential for homeowners to stay informed and consult with a mortgage professional to understand how these changes might affect their individual situations.
It's like taking one step forward and half a step backwards. And then there's the whole policy uncertainty thing. The U.S. administration's policies could shake things up for trade. And let's not forget about our own federal election coming this year. How do you think this uncertainty affects the real estate and the economy here in Canada?
Right now, we're dealing with a mix of economic progress and lingering uncertainty. And both global and domestic factors could impact real estate and the economy in Canada. The U.S. administration stance on trade, interest rates, and economic policies has a direct impact on Canada, especially when it comes to supply chains, investments, and inflation. If the U.S. economy slows down or trade policies become more restrictive, it could put pressure on Canada's exports and the overall economic growth. Pending federal election adds another layer of unpredictability. Depending on which party wins, we could see shifts in tax policies, housing affordability measures, and regulations affecting real estate and investment. Buyers and sellers may hold off on major decisions until there are more clarity on government policies. Now, the Bank of Canada cautiously is lowering rates, but if inflation remains volatile, they may pause or slow down those rate cuts, keeping borrowing costs higher than expected. This would affect home affordability and investment activity. Real estate investors are closely watching these factors. If uncertainty continues, foreign and institutional investors may wait on the sidelines, which could lead to slower market activities actually in some regions. So what's the bottom line? Uncertainty leads to, hesitation. And in real estate, that means some buyers and sellers may wait to see how things play out before making big moves. It's a time to stay informed and be strategic with their investments.
Then you've also got immigration, which is supposed to be slowing down. Canada's reducing its immigration targets this year, which might ease housing demand slightly, but it could also slow population growth down as well. That's bad for the labor market and overall economy expansion, is it not?
Well, exactly, Ricky. Canada's decision to reduce immigration targets is a double-edged sword. It may help cool down housing demand in the short term, but it can also hurt economic growth and the labor market in the long run. Lower immigration means fewer newer buyers and renters, especially in major cities like Toronto and Vancouver, where new immigrants significantly drive demand. This could slightly ease housing shortage, but won't necessarily lead to major drop in prices. Immigration is a key driver of workforce growth, and reducing targets could lead to labor shortages in key sectors like construction, healthcare, and tech. That could slow productivity and push wages higher, adding to inflation pressures. With an aging population, Canada needs immigration to sustain economical expansion. Slower population growth means fewer workers, lower consumer spending, and less business investments, which could drag down the GDP growth over time. Fewer newcomers also means less tax revenue, which could put pressure on public services and increase government deficits. So, while lower immigration targets might take some pressure off the housing market, they could also lead to long-term economic slowdowns and labor shortages, which isn't really great for Canada's overall growth.
So in other words, the economy is dependent on immigration.
Yeah, Canada's been big on immigration always.
So controlled inflation is great, but on the other hand, essentials are still very pricey. Lower rates might help, but only if people and businesses feel confident enough to spend and invest, correct or not?
Well, yeah, actually you are. Lowering interest rates is meant to stimulate the economy, but it only works if people and businesses feel confident enough to spend and invest. So right now, there are a few factors at play. So right now, even though inflation is moderate, the cost of essentials like groceries, rent, and fuel is still high. That means many households are cautious with their spending, especially if their wages have not kept in pace with the inflation. Well, when the Bank of Canada lowers its rates, borrowing becomes cheaper. This can boost consumer spending and business investment, but only if people trust that the economy is stable and won't experience more price shocks. Companies won't invest in expansions or hire if they think the economy is kind of uncertain. So if businesses hold back, job growth slows, and that could keep consumers spending low, even if borrowing costs drop. Lowering the rate could make mortgages more affordable, but if buyers lack confidence in the economy, they may still wait before making big purchases. So while rate cuts can help, they don't automatically lead to higher spending and investment. Confidence is key. If people still feel financial strain and businesses remain cautious, the economic boost for lower rates could weaken than actually expected.
Can you believe it? It's only February right now, and so much has happened already within a short span of time. We'll just have to wait and see what else happens throughout the year and how it plays out. Who knows? Maybe we'll all be Americans by the end of the year, the way things are heading, it seems like.
You're right about one thing. 2025 has already begun with full of surprises, and we're even just barely getting started. Between policy changes, interest rate decisions, and federal elections on the horizon, things could swing in several different directions. Canada is heavily tied to the U.S. economy, and whatever whatever happens there, we don't know. Whether it's trade policies, election outcomes, or the interest rate shift, how will that affect us? If inflation, immigration policies, and taxations keep going the way it is, real estate markets could see major shifts, either pushing more Canadians into homeownership or making it even harder. We're also dealing with global conflicts, supply chains, distributions, and involving economic policies. So kind of tough to predict what the next big challenge or opportunity will be. So while I don't think we're all going to become Americans anytime soon, 2025 is shaping up to be a year with adaptability, and smart financial planning will be more important than ever.
And that wraps up our video for today, everyone. So stay tuned for our moving to and investing in Dubai episode. Still in the works right now. We'll be dropping near the end of this month with a realtor who used to live in BC, but now they have been living and selling real estate in Dubai for quite some time. Very excited about that because I've always wanted to go to Dubai. Don't forget to like, share, and subscribe to the Surrey BC Real Estate Podcast, available on all streaming audio platforms as well. Thanks for watching, everyone, and we'll see you on the next episode.